TTF front month, TTF front season, NBP front month, NBP front season, and German power markets are all set to move lower at the start of this week on the 26th of January 2026. Only the carbon emission certificates look like they could push higher, and Brent is also ready to make a move higher. Hello, everyone. My name is Marcello Colax. I'm the managing director at Clever Markets, and today I'm going to walk you through the European energy charts for the week ahead. Of course, as always, everything I'm sharing here is just my personal opinions and not an invitation to trading. All right, this is the TTF sentiment benchmark as of this Monday. What we're seeing here that from 2 weeks ago, so from last Monday, we did have a higher percentage of bulls in comparison to the bears. The bulls were in the market with 50% and 34% of you were bearish inclined, and we only had around like 10% of those thinking the market is most likely to go sideways. This week, it's looking a little bit different. So here, 43% of you think that the market is more likely to go down compared to the 36% of those thinking the market will move higher. This broader alignment in the bearish sentiment is also seen in the charts. So there's no big surprises here. In a moment, I'll be showing you some very important trigger levels as to when the bearish case is confirmed, because then we might see some of the bulls liquidate their positions and then maybe getting in on the short side, which would fuel the initial down leg. Because overall, 36% still is a reasonably large chunk of the market. I'll also show you what it would mean when the bulls will actually be in charge and when the bearish case is invalidated. All that in just a second. So this is the front page of our dashboard as of this Monday morning. You can see the bulls are in charge on the hourly, on the daily, on the weekly charts for the TTF and the NBP. German power is still a little bit sideways all across the time frames. Doesn't mean that nothing is going to happen. So what you're seeing here are not some market predictions. These are just showing us what the market is currently doing. And we do believe that the German power markets might be moving lower at the start of the session. Same for the EUAs. It doesn't mean that the hourly and daily chart are not going to move this Monday morning. It just means that right now, as we are starting out this week, there is no clear direction, but we will very quickly show you where the market might be going. Brent has a chance to move higher in a market that's overall still pushing a little bit sideways. So range market trading, mean reversion trading. Before I go any further, if you are not already subscribed to the Clever Markets newsletter, then do so right now. This is completely for free. You will get to your inbox this video, the TTF benchmark, some market commentary, and a proper TTF front month analysis every Monday, 7 a.m. CET to your inbox. All right, let's get going with the TTF front month. As always, we start with the weekly chart, and you can see we have transitioned from this big downtrend within just 2 weeks into this major bull trend on high volume. I mean, it is the start of the year, it is the start of a new contract, and the market just went for it. You can see that the trend tools, the 8 and 12 exponential moving average, is pointing higher. We are also seeing that the MACD, the momentum tool, is pushing higher. We are almost getting a move above zero, which would then turn the market towards bullish momentum. And we are seeing that the stochastic isn't even in overbought territory yet, and we are not really expecting a big bearish signal. Now, here's the thing. The move happened on just 1 week with really strong volume. So this is alone just pushing indicators higher. But do not be deceived. Our in-house algos are showing us that the market might be ready to top out. What we are seeing here is not sustainable, and eventually we are expecting the market to move lower. It's not going to happen within just a session. You can see we are on the daily chart predicting a little bit of a sideways move before we actually make a decision. So what are the levels that we are dealing with? You see, we put on the Fibonacci retracement levels, the 0 up here and the 100 down there at the 8th of January, and the peak is on the 22nd of January. We are pointing out the 23.6% Fib retracement, which was pierced left and right, so it's not really of much value, but we did put in the 38.2% Fib retracement at 36.24. Now, the peak is at 41.91. So that means within 36.24 and 41.91, we expect the market to move a little bit sideways. And you can see that here, right? We did have this big, strong bullish green candle on the 21st of Jan. Then the next day, we have this bearish reversal candle that, in theory, could have set the market up for a decline, but didn't happen and we continued sideways. So, and we do expect a sideways continuation for a little bit longer. Ultimately, yes, we are still bearish inclined, and traders are not advised to chase this bull trend as it is potentially topping out. So, why do we think that the market is topping out? Well, that is best observed on the hourly chart. So, let's have a look at this together. Remember on the daily chart, the strong up leg, this is nearly untradeable on the daily chart alone. So, of course, for that, we are always trying to go into the hourly chart in order to trade with the swings. A lot more tradable than just trying to guess the color of the next candle, right? And we can see that with the last upswing, the momentum started to move lower. So this is called divergence. It's called momentum divergence, which simply means price is going up, momentum is going down, so the bulls are slowly exhausted. This in itself is not a trading signal. We don't trade on that. But we are getting a little bit more careful. Maybe if you're already long, maybe you decide to fade a little bit. If you're on the sidelines, maybe the long trades that you're entering are not as large in size anymore because we do expect the market to top out and the up legs are getting shorter. Or maybe you decide to not enter anything long right now. But just because we see momentum divergence doesn't mean we're making big directional decisions. Okay, so this is not what the tool is for. Now let's have a look at what happened at the end of last week. We are getting this here, right? Super interesting. The market is still making higher highs and higher lows until here. We get a new higher peak. We move lower. We are still getting a new higher trough. So it's all looking good. The bull trend just continued. But what is this? By the end of last Friday, we see that the market started to top out exactly where it has topped out previously. We see on the MACD that we are making lower peaks. Okay, that is once again a sign of exhaustion. We are also seeing that the stochastic, our oscillator of choice, is in overbought territory and gave a preliminary bearish signal with the white line crossing below the orange line, %K crossing below %D. And also you can see we are making a lower peak overall, but the real bearish signal would only be given below 80, which might be happen fairly soon. So now the next question is, okay, so the bulls are exhausted. We are topping out where we've topped out before. This can mean one of two things. It could turn out to be a rectangle if the decline this morning bottoms out near 36.26, and then we could just continue sideways a little bit, which would be in line with our daily charts preferred scenario where we are just continuing sideways, right? So that's the sideways arrow on the daily chart. Alternatively, I mean, there's a few things that could happen, but another alternative would be building a double top. If we maybe top out here, or maybe push a little bit higher towards the 42 area and then continue lower. But this could then turn out to be a double top. And the double top has a neckline down here at a 36.26. And a double top is showing us that the bulls tried to push higher, but failed twice. So eventually this means bearishness. That's why double tops usually bearish. But both patterns, the rectangle and the double top, no matter how we see it, the bearishness would be activated below 36.26. And that would then also lead to a bigger corrective move on the daily chart. Can you see 36.26 is the neckline and 36.24, very close, is also below the 38.2% Fib retracement on the daily chart. So no matter what strategy you're working with, no matter what you're expecting on the hourly chart to happen, everyone is looking more or less at the same levels. And that's why it's so critical. If we push below this, the bears will be in charge, potentially at least towards 32.68, which is the 61.8% Fib retracement on the daily chart and also aligns with the 200-day exponential moving average. Pretty cool, right? So when is this whole sideways and bearish assessment wrong? Well, if we move above 42, or to be more precise, 41.91, then the bulls will simply push onwards towards the 45.5. Looking at the daily chart's bullish momentum, this is still possible. So this is a very valid alternative scenario. Also from a stochastic perspective, no bearish signal yet. And the trend tools are also still pulling higher. So scenario 2, also nothing crazy. We try to not predict the market. We just sit back, let the market do its thing, and once we get a confirmation either way, then we do with that. It is okay to have a preferred and alternative scenario in our heads, but in the end, we always have to wait it out. But for us, the preferred scenario is sideways and then a little bit down. And that's all for the TTF front month. Now let's have a quick look at the TTF front season. So here the scenario is similar, but the details do differ a little bit. So you can see after a downtrend, we had an extended sideways period, and now the market pushed significantly higher. All exactly the same. We had 2 weeks ago, we had this bearish shooting star candle pattern, which was not confirmed the week after, so last week, but instead we did get another bearish candle. It is not quite a hanging man because for that the upper wick is a little bit too long, but the idea remains the same. The bears tried to push lower, which is the first sign of bullish weakness. So what I find even more interesting on the TTF front season is the hourly chart. Look at that. We are not dealing with a sideways range as we do on the TTF front month. Here we are dealing with an ascending channel. The upper end of the ascending channel is no longer hit, which is a sign of bullish weakness. And this corroborates with what we are seeing on the MACD as well, our momentum tools, where the price was still moving higher, the MACD was moving lower, which means divergence. So that makes a move below the ascending channel more likely. And here I would like to keep an eye on the psychologically important 30, which is this trough, which is also the ascending channel support. So all of these compound in this 30 area. So no matter what trading strategy someone might be looking at, we are all looking at the 30. So if we push below it, the move might happen quickly. So do keep an eye on that. If, however, we start pushing above the 31.17, then the bulls will be given another chance to at least push towards 33.11. But if the TTF front month is any indication, the bulls would really struggle to make significant gains beyond that point. Now, what are German power traders up to? Let's have a look at the annual contract. So here on the weekly chart, we have been moving into this increasingly tighter range since forever, which also means that momentum trading opportunities have become smaller and smaller overall. Right now, we are near the 87, 88 resistance area. The market seems to be feeling out a peak, and looking at the oscillator of choice, the slow stochastic, we see that we did get a bearish signal and the market overall is pointing lower. So we do believe that below 86.41, the bears are likely to continue. Of course, the bulls would be in charge above the range, above the 87, 88 resistance zone. So let's have a look at the daily chart to make this tradable. What I find interesting is that although, yes, we are moving into an increasingly tighter range, and I usually say that in a range market, we try to ignore trend and momentum tools. This is still true. So ideally, we wouldn't be looking at, let's say, the MACD or the moving averages or Bollinger Bands or Ichimoku clouds or anything that's based on a trend or momentum tool or is calculated with a moving average as a rule of thumb. But in this case, the swings are still really broad. You can see going from 80 to 88. So when we have these still like €8 swings, then the momentum and trend tools can still sometimes be useful. And here we are seeing that trend momentum tools are still overall pointing higher, but the stochastic is giving us a bearish signal. So this means that we might be pointing lower before we try higher again. So how low can it go? Well, one option would be towards this trough support here near 83.96, let's call it 84, or even later somewhere around the 200-day exponential moving average in the 82, 83 area. If we find support somewhere here, then the bulls might try again. Chances of the market pushing lower are quite good because we did end last Friday with a shooting star near an important resistance level and confirming stochastics. So there's a good chance that we push lower. The idea of bearishness would be invalidated above 87.55, which would be the upper end of this shooting star, because then the bearish pattern would be invalidated. We would move above the ascending triangle, and then the bulls would be given a chance. So super good, right? We are working with some really clear levels as well as targets once the trigger levels are surpassed. Now, let's have a look at the hourly chart because that's where we are fine-tuning our trading decisions. So you can see here the market has come up quite a bit. We are making higher highs and higher lows. We had this significant decline towards the 84.4. We pushed higher again, but we are kind of topping out exactly where we did previously near the 88 level, which on the daily chart is this really important ascending triangle resistance. So there is a chance that we are forming a double top, but you can see double top question mark because it would only be a confirmed or completed double top if we make it below this tentative neckline near 84.4. Only then would we really be saying, yes, now the market also on the daily chart is ready to push lower significantly. For now, looking at the trend and momentum tools, it does make sense. The 8 and 12 exponential moving averages, our trend tools, are pointing lower. We are also seeing that the MACD is pointing lower and we have made a new lower peak overall. And we are seeing that the stochastic is moving lower as well. Don't worry, moving into oversold territory doesn't mean the market will bounce. It simply means we got a trend going on. A bullish signal would only be given if we move above the oversold level, above 20 again. Not happening right now. So overall, it's all looking set to move from the 86.12 towards the 84.4. And here, the market needs to make a decision. This is where buying could set in. And then this tentative double top would turn into a range market, into a rectangle, exactly as it is a possibility on the TTF. If we move below it, however, then we would get our full-on bearish correction. Now let's have a look at the carbon markets. Here on the weekly chart, we see that the market is still broadly moving within this really, really wide ascending channel. Zooming in, we have hit the upper end of this channel in the 91.3, 92 area. And last week turned out to be a hanging man. So a hanging man at this important resistance level would usually mean a decline. And bearishness would be validated below 83.52 and this bearish setup would be invalidated above 91.3. Now you're wondering, hey, this is a really wide range. How do we trade this? Well, we don't, and you're right. This bearish candle pattern is just there as a warning. It's a signpost. This is untradeable also on the weekly chart because the levels are just so far apart. So what we do instead, we look at the lower level charts, like the daily chart and the hourly chart, to actually make this tradable. But here we wouldn't really derive any actionable trigger levels on the weekly chart. But just for the fun of it, let's have a look at the stochastic, right? So we are nearly getting we got a bearish signal here with the move below the overbought territory, which sets the market up for a decline. And you might be wondering, okay, so with this bearish setup, why are we still broadly bullish? Well, this is best visible on the daily chart, where we are still expecting the market to recover quite a bit. And we know, yes, we make the analysis top down, but the markets usually move bottom up. So the first signals are usually given from the lower level charts and then they filter through to the higher level charts. So let's have a look at the daily chart. Let's briefly backtrack a little bit on the daily chart. So you can see here on the 14th of January, we started to hit the upper end of the daily chart's ascending channel resistance. And at this point, our in-house algos were already predicting that the market is going to push lower fairly soon. The bulls were overextended. And then, of course, over the next two sessions, we did get these two bearish reversal candles, which turned out to be a double top on the hourly chart. So here our bearish stance was then given some really actionable trigger levels. And then the market declined as expected, just past the ascending channel support. But our algos were showing that this break lower is likely to be short-lived. And already on the 20th of January, we are saying that, hey, the market is very likely to bounce, which then also happened. Once again, here we are on the daily chart, and you can already see we are almost starting to guess the color of the next candle. So this whole down leg and subsequent up leg are best traded on the hourly chart. This is nothing for the daily chart. Now, What do we think will happen next? Our in-house algos still have a weak bullish bias within a neutral regime. So neutral regime simply means the market is mean reverting, it's going sideways. So overall, short positions still remain under track and we are still expecting a gradual accumulation towards 93.8, which is the peak that we hit on the 15th of January. Remember, weak bullish trend within a non-trending market. So hoping for any big momentum play right now might not be advisable. Let's have a look at the hourly chart. So here we're seeing that the market is swinging within this reasonably tight range, 87.75, 89.69, and overall there is an okay chance for us to push above this. Within these ranges, we do expect the momentum within this range, we do expect the momentum to taper off anyway. So this is not a real bearish signal overall. And we also do expect the 8 and 12 exponential moving averages to flatten out a little bit. This is completely normal within ranges. Now, why do we maintain an overall bullish stance? That's simply because of what the daily chart, the higher level time frame, is showing us. Our bullish stance would be invalidated on the hourly chart below 87.75. And then you can see we are already working with FIB extensions. Then this down leg after a correction would most likely continue here. 84.58 is the 61.8% FIB extension, which is kind of near this trough. And if we push below that, then we could make it all the way towards 80.73, which is the 100% extension. That seems a little bit less likely right now, but if it happens, we have clear trigger levels and clear targets right away. But overall, our stance is still fairly bullish, at least towards this gap resistance border at 91.85. So I now want to spend just one moment on the Brent markets. Here on the daily chart, we see that we have formed this double bottom with this neckline. We did push above it as expected, and we are now testing the 200-day exponential moving average resistance. For now, we do expect a marginal move higher, but the bulls overall seem exhausted, and there haven't been a lot of dip buying opportunities overall on the daily chart. If anything, probably any dip buying might have happened on the hourly chart, and that's not going to change anytime soon. So the real trading opportunities are on the lower level time frames, because you can see we have these candles that are very tightly stacked over the past week at least, so there were not many opportunities. Overall, we see that the MACD is still pulling higher, the trend tools are still pulling higher. We are not really seeing any bearish signal on the stochastic. So yeah, we can try this again. And then the market has to make a choice. Either continue higher, which seems to be the alternative, or peaking out and correcting lower. Now, on the hourly chart, we are already dealing with an ascending channel that was broken to the upside. So that simply meant bullish acceleration. The bulls are getting stronger and bolder and bolder. This is reflected on the rising momentum tools, no bearish signals on the stochastic, and also rising moving averages. So overall, we do expect a move above 66.33 this morning, potentially towards 66.81. This also is the last significant resistance level that we are seeing. So we do expect some profit taking here. You can see we do expect the market to move a little bit lower, but whether or not this is going to be a correction or full-on trend reversal will later have to be identified with the help of momentum tools on both time frames to see if there's a chance for us to correct lower. That's all from me today. I hope you found some value in these updates. Everyone stay safe there in the market. See you around and bye bye.